Welcome back to Yahoo Finance Live. I'm Emily McCormick. Well, some major changes at Turkey's central bank. The Turkish Lira down sharply today after Turkish President Erdogan removed the country's central bank governor, Naci Agbal, after just 4 months. Now, joining us is Emily Weis, Street Macro Strategist. And Emily, I want to start off with that news because outside of the moves that we're seeing in FX markets today in the wake of this reshuffling, I'm wondering if this also changes the calculus to your mind for investing in emerging markets or in that pocket of the world as a result of these moves.
Yeah, that's a great place to start because we came into this year very optimistic on the emerging market backdrop, looking at this improved global recovery alongside an improvement in commodities and seeing that rebound in global growth that was all set to benefit emerging markets, particularly as the Fed was going to indicate that they were on hold. Now, all of that background still broadly applies, but certainly we are starting to see some more problematic speed bumps on this emerging market path. And certainly higher yields has proved to be one, but more importantly today, it's really the story in Turkey where we're seeing that the removal of the central bank governor, leading up to now be the third central bank governor in the last 21 months, has brought in a renewed volatility after policy was just starting to regain strength and was really just starting to seem like it was returning to a more economic orthodox policy rather than something motivated by political ambitions. So while it's certainly something that we are watching very closely today, it does seem like at the moment, this is idiosyncratic to Turkey's story, and we don't expect it to have broader spillover effects to the rest of EM. Notably, when you look at correlations over the last few years, the correlations between other emerging market currencies and the Turkish lira has been declining. So there is less of an impact now than there has been, as many of these issues are very Turkey specific.
So, Emily, it's great to see you, Brian, here. I want to ask about the longer-term bond yields here in the United States, because you point out quite rightly in your note that, in general, it's not like, higher yields in the United States are negative for all emerging markets. So when we look at 10-year, it seems like we've kind of reached a structural kind of point with the Fed meeting last week, but people are saying, don't be surprised to see 200 basis points on the 10-year. What is the outlook for emerging markets given that type of expectation?
You're exactly right, Brian. There is this push higher in yields that we do expect to continue, investors having to continue to push yields higher given the Fed's recent reaction function. And that does bring up an interesting dynamic in emerging markets. I think it's brought people back to a lot of other times of EM specific stress, most importantly, the taper tantrum. But there's a few important distinctions this time. Notably, first of all, the Fed isn't tapering. And that was a key thing for the 2013 taper tantrum, where you had Ben Bernanke announce that they were about to embark on this normalization process. We do not have that this time. The second thing is that EM countries are generally in a much better position fundamentally this time around than they were back in 2013. So notably, many countries have improved upon their current account and external balances. We've seen that there's broadly a little bit less foreign participation in these local currency bond markets. That capital can tend to be quite volatile and can move pretty quickly at any signs of stress. And then lastly, many emerging markets actually have significantly higher yields right now than what we're seeing in the US. So certainly being able to maintain that significant differential has also helped keep some capital at home and hasn't resulted in the same sort of stress so far than what we've seen in other episodes of developed market yields bleeding over into the EM space. And we certainly think that's set to continue.
Now, of course, you mentioned the real rate differentials. Of course, central banks are all trying to get in lockstep here to make sure that the FX markets don't get too crazy. But at the same time, it is still a story that the US dollar strengthening is going to have an impact. Now, on one hand, that could increase the purchasing power here in the United States to take on exports from those emerging markets. But is that necessarily a good story? Because some of these countries that are also emerging markets are the ones that are also struggling the most with the virus itself. So what does that look like? How does that complicate things?
It's complicated, to your point exactly, where we have this back and forth scenario where higher yields don't necessarily have to be bad for emerging markets. In particular, US higher yields can actually be a positive if it indicates that the growth outlook is improving, which is what we're seeing right now. When it does become an issue is when the dollar starts to rise and then strengthen significantly. That ends up being a net negative for emerging markets across EM equities, fixed income, and FX, pretty severe negative. So certainly this dollar trade that has been showing a steeping of appreciation versus both G10 and also versus the emerging market complex is a concern and is something to watch. And I think right now it is driven by that point that you mentioned of the US economy is recovering faster than many of its other global peers. So at the moment, given how we've seen the vaccine rollout happen in the G10 space, many of the countries that have been most impacted negatively by COVID, including the US and the UK, have had some of the better vaccine rollouts of the complex. And of course, Europe continues to struggle on that front as well. Meanwhile, though, on the emerging market side, we find that the rollouts generally have been a lot slower, with the exception of really Israel and to some extent Chile. And so when we look at that complex and see the countries that have been the most impacted, such as Mexico and unfortunately Brazil, still going through a terrible situation right now, we see that those rollouts haven't even really gotten started. So there's a lot of potential improvement to be made, and we know that the help will be coming, but unfortunately it's not happening as quickly as we would have hoped. And that is leading to a divergence in growth expectations for the US versus the rest of the world.
Absolutely, a divergence that just shows it's really not as fast as recovery as we're seeing here in the United States in many corners of the world. But Emily Weis, Street Macro Strategist, thanks for stopping by Yahoo Finance today.